Ladies and gentlemen, welcome back to Talking Numbers. It is my special Talking Numbers podcast series. It's my new one, and it's my Property Plus series. I hope you've enjoyed the first 4 episodes. We're into episode 5. In case you don't know, my name is Paul Jansz, and look, I've got the pleasure of chatting to some great people in our industry, talking about some great things. This series is brought to you by Virtual Financial and Jay Anderson Property. And I've had the pleasure of chatting to Jay Anderson over the last 4 episodes. We've been talking about some key things around property, mistakes or the 6, let's call it the 6 most common mistakes to avoid when purchasing an investment property. We've gone into rent vesting. What is it? Again, if you don't know what that is, go back and listen to episode number 2. We've gone into a housing market update, which has been fantastic, because people want to know what's going on, what is happening in the markets around Australia. We've also gone into some interstate. So if you're looking at interstate investments, how can that work for you? What's affordable? When's a good time to buy? Do you have to physically see the property? So these are all the extra layer of educational information we're bringing to you in this Talking Numbers series, which has been fantastic. Now, today, before I introduce Jay back, today we're talking about the investment journey and having a little bit of fun there. Jay, welcome back to Talking Numbers.
Thanks for having me, and looking forward to our chat.
Yeah, absolutely, mate. How are you doing? You're okay?
Good. Yep.
Both having a little bit of a cough along here, so we apologise to anyone if we do have to clear our little lungs and our throats. Middle of winter is not good, but that's life. All good. So, mate, let's get into today's show, and we're going to talk about the investment journey. Tell us about that. So, what are all the things that we need to consider before buying an investment property?
Yeah. So, I guess I actually get this question a lot from investors wanting to start out. That's kind of where do we start? What's involved? How does it work? So, I think the first, areas to really look at is not only you got to understand what your budget is, so getting pre-approval from a mortgage broker, understand how much you can actually borrow and what your budget is. But then there are a lot of hidden costs or unknown costs when it comes to buying a property. So understanding, what those costs are and what's involved in being a property investor, the time required, the financial discipline of managing money. And then you also need to think about, what structure are you going to buy the property in? So making the wrong decision in the beginning can have financial impacts or tax implications later on. So it's really important to seek advice from your accountant or financial advisor who can determine, the best structure for you to hold your assets in, whether it be personal name, trust, or another entity. So they're kind of the high level areas to consider before you even think about getting an investment property. It's important to go through that process and start mapping out all of that before you even start looking at property.
So where's the starting point? Is the starting point as an example to chat to someone like you and then go and chat to your accountant? Because to be fair, if you're looking at it from and most people do look at it from a tax perspective. So depending on the type of property, and we've spoken about that in the last few episodes in terms of the type of property you should get into, the depreciation, how the land holds the value. And you're right. I think the key thing that we mentioned, and obviously, Talking Numbers is aimed at the accounting industry. So talking to your accountant is a critical one, because where are the tax savings, tax implications? The structure, as you mentioned, is probably a really important, whether it's personal, trust, self-managed super fund. What's going to give you the greatest outcome? That's probably the important factor, which your accountant is probably best to advise on. Fair to say.
Yeah, definitely. And we take it one step further in that I always encourage that you've got these professionals around you, but sometimes it can be quite segmented, as in that you go and speak to your accountant, and then you come and speak to your buyer's agent, and then you come speak to your mortgage broker, and you can be getting sometimes conflicting information, or it's a little bit confusing. So I always encourage with clients is, let's get your team of professionals together. Let's jump on a Zoom call. Let's jump on open up the communication between each other, where me as a buyer's agent can say, for you, Paul, we're thinking about buying a capital growth property with, development upside that you might come back and revisit in 5 to 10 years to subdivide and do a development. Some of that information may influence, the structure or stuff that the accountant, might advise on. And then depending on the structure, that's going to potentially impact on the borrowing side with the mortgage broker. So if we're all, essentially doing a roundtable discussion, then you've got everyone on the same page, working for the same goal and working with your, for your best interests.
That's a very good point. And I think given that Virtual Financial's involved in this as well, and for those of you that don't know Adam Beserovic, Adam is also a CPA. So from a Virtual Financial point of view, and talking to, let's call it your financial advisor, who can obviously advise on that. And then if it's a tax side of it, he can also bring that into it as well. And then working with Jay, I think call it a property buyer's agent. I think that's a very, very good point in terms of making sure you've got that. Because I agree, I've been in the situation where sometimes you can get that conflicting opinion, and then the old scenario happens where, oh, look, I'm not sure, I'll just put my hands in the pockets and do nothing.
Yeah.
And that's probably the bit you don't want. You want people working together to achieve your goal. And right from episode 1, we spoke about the why, what's your strategic plan. If you're really clear on what that plan is and why you're buying an investment property and where you're buying that investment property, that should just flow seamlessly through to the professionals that are working for you.
Definitely, yeah, spot on. And like I said, talking to someone like Adam or a financial planner, financial advisor, the property piece that we're talking about is just fitting one part of that kind of wealth creation, wealth management. So it's important to have, all of those professionals in the room at the same time. So you're understanding the bigger picture and looking at it in a holistic way.
100%. So tell us about the costs that are involved then.
Yeah, so the big one's obviously deposit. So depending on your borrowing capacity or the savings you've got, typically deposit, might be somewhere around, 20%, could be 10% of the purchase price. Depending on the lender and their policies and what industry you're in and a number of different factors, if you've got a deposit less than 20%, it can result in triggering what we call lender's mortgage insurance, which is an interesting thing on its own, because it's essentially you're paying for an insurance policy for the bank against the risk they have with you borrowing. So you're paying their insurance policy against you. But again, it depends on, there's some lenders out there that, if you're in a certain industry, you don't have to pay lender's mortgage insurance. And that's where it's really, really important to have an experienced mortgage broker on your side.
Yes.
So they can look at your individual circumstances and then go out and match you with the right lender, with the right loan product. Then the other additional costs or, acquisition costs, in addition to deposit, things like stamp duty, which will vary state to state. Sometimes there's some lending charges and fees. You've got solicitor or conveyancing fees, building and pest inspection, and then, obviously your professional fees as well, whether that be buyer's agent and accountants and stuff like that, if you're setting up trusts and whatnot. So as a rough rule of thumb, because it does vary state to state, there's different calculators you can jump on and work out, what the stamp duty would be on a property of X value in this state. But as a rough rule of thumb, excluding professional costs, so excluding buyer's agent and accounting fees and stuff like that. But if we look at stamp duty, lending, legal fees, building and pest, as a rough rule of thumb, we'll add 5% of the purchase price is a quick kind of rule of thumb to.
Right. And do lenders lend that 5%, or is that something you need to find?
It's something you need to find, unless you're in a scenario where you've got equity in other properties and you can extract that equity. So if you had principal place of residence or another investment property that had equity in there, and you could take that equity, you could use that equity to fund deposit, stamp duty, legals, buyer's agency fees, all the rest of it.
Okay. So typically, if you came up with your 20% deposit, you could, at the end of the day, if you need to take 5% out of the 20 and you end up with 15, and you might have to come up with a little bit of mortgage insurance, there's ways of balancing that up.
Correct.
Yep. Okay. Good to know. And I suppose, look, your accountant's cost, it's like anything, good to ask up front. And that's one of the things that I know I always ask my accountant, because the last thing you want to do is get an invoice and go, well, shit, that's not what I was expecting. So really important to ask, if I was going to go down this road, what would your fees be? And I suppose to someone like yours, in terms of professional fees, your fees are always outlined up front as well.
Correct.
Okay, good. Now we're going to get to buyer's agents next as well. So as part of our next episode, and we're going to give everyone I've already mentioned it, haven't I? So I was going to say, we're going to give everyone a tease, but we're going to go into exactly what that is. So for those of you continuing to listen to this series, I think it's important that, and we've been very pro buyer's agents for a number of different reasons. The main one being you don't get caught up in the emotional side of things, and someone's just there to act on your behalf to buy at the right price with the right data and the right research. So we're going to go into that in the next episode. So probably the next one for me is, when I'm thinking about my own situation, is, so when, where, and what should you buy?
Yeah, and that's probably the most common question we get. Is
I can imagine.
It really depends on the individual circumstances, as you could probably make out. However, where it's I guess the when is very interesting. When should I buy? Is it a good time to be buying, or is it a bad time to be buying? And there's certainly bad times to be buying in different markets. But I think, taking a step back, your personal circumstances, you personally need to be in the right position and at the right time in your life to be able to buy a property. So, as an example, if you don't have a stable income, or there's uncertainty around income in the future, you maybe don't have a solid budget where you've got a clear understanding of where your money's being spent and stuff like that, now might not be a good time to buy, because it is a big financial costs and stuff like that. So it's sometimes important to get your own finances under control and get an understanding around those before just rushing out and going to buy a property.
Yes.
On the other hand, if you've been saving for a number of years, you've saved up a deposit, and you're good with your money management, and you've got surplus cash flow and stuff like that, then mapping out what you're trying to achieve, then it's a good time to be buying a property. The only thing that ever changes is where we're buying a property.
Yes.
So if we're just looking in a single market, we can certainly say, look, now's not a good time. Now's a great time. Now's a bit unsure. But if you're looking at it purely from an investment point of view, it's just about finding where are the good buying opportunities right now that align with your budget and circumstances.
So mate, if I was thinking, the first thing that springs to my mind is probably, I'll put it from my own personal point of view, probably a more at a lesser, if that makes sense. So let's say 2 or 3 at the 500,000 level instead of buying something at 1.5.
Yeah.
Can you get properties for 500K?
Definitely. Yeah. And that's a good strategy. I guess it's a good discussion point we have with clients all the time, is if you come and say, I've got 1.5 million to spend on an investment property, is going out and buying one property at 1.5 million actually the smartest thing for you? Or does it make sense of splitting that up into maybe 3 $500,000 properties, maybe in different states, different markets? Not only you get to diversify into different markets, but it's great for some cash flow risk mitigation as well. Because if you've just got one investment property at 1.5 million, something happens with that property or the tenant moves out, your rental income has stopped, but you've still got that full loan amount and loan repayments, where we can get quite creative in the sense that if you bought 3 $500,000 properties in different markets, different states, each of those markets are going to be at a different point in time in terms of their life cycle and their growth cycle. But then we could stagger the leases. So let's say property number 1, 12-month lease expires in January. Property number 2, it expires in June. Property number 3, it expires in October. And you're controlling those fixed term leases on each of those properties. So you're actually never in a position where you've got all the properties or more than one property vacant at one time, which can, be great in terms of managing cash flow risk.
Clever. Look, that's how my brain went to as well, because I think it's about diversifying risk. So I'm glad you actually went into that and shared that in a little bit more detail, because you're right. I never thought about the lease side of it, but that takes another risk mitigation into place as well.
Yeah, definitely. So I guess we've spoken about the when and a little bit on the where, but I guess extending on the where to buy, there's nearly 16,000 suburbs in Australia. And you got to think each of those suburbs actually have sub-markets within those. When you think about an area you grew up in or an area where you live now, there's better streets than there are others in every suburb. There's different property types, whether it's houses, units, and different price points within a suburb. So not only there's nearly 16,000 suburbs, but then each suburb's got its own sub-markets as well. So before even thinking about where to buy, you got to understand the some key factors like your budget. Are there any minimum rental yield requirements? What's the strategy? What are the goals? And then you can start matching your circumstances to suburbs that complement that strategy that you've got. So it's not as easy as just saying, asking your neighbor or your mate at a barbecue on a Sunday, hey mate, where should I buy a property?
Yes.
Because really they don't know what your strategy is, what your goal is, or anything else. And if you just follow what they did, they can be in a very different stage of life, different financial circumstances. And that's where we see a lot of investors, I think, fall into some trouble is, they follow the masses or follow the opinions of non-professionals, which in any space can end up being quite dangerous.
Yeah, and I think you're right. It's a really interesting one that we tend to do that because that's what other people are doing. So it's the old not leading, following, I suppose. And you go off other people. I was out to dinner last night, and we were actually talking about this, and sort of the guys were talking about, funnily enough, investing, and they were talking about different. And one was very keen on crypto, and he was trying to convince us on crypto. Someone else was talking about government bonds, funnily enough. And then, of course, and I'll say the Italians, because the Italians like property. They were talking about the value in and their family. One of the guys they just buy property. That's all they do is buy residential property. It's worked for them for generations and generations. And there's no reason why they want to shift to something like a crypto, which, they see is just, there's no one in the world that'll be touching that. Because that's the old scenario. What and there's plenty of data and expertise that comes with property.
Yeah, definitely. And then I think the last bit that we need to touch on is, what to buy. And
yes,
I have this saying that I tell people all the time is asset selection. So the actual house itself is the very last piece of the puzzle. So when a lot of DIY investors are doing it themselves, yes, they get the budget, but then they start looking at houses and not a lot of focus on individual street or suburbs. It's more, hey, what's the nicest, prettiest house, or the house that I would probably personally like to live in the most for my budget. The actual house itself has the least impact on its overall performance. The suburb, the street, all have a much greater impact on that long-term performance of that property than the appearance of the property itself. So the actual house selection is the very last piece of the puzzle. You got to get the strategy, location, street level. So it's not just about finding what a suburb to buy in. It's what streets within that suburb do we want to focus on? And sometimes more importantly, what streets do we not want to be buying on in that suburb? Some of the way, and we could maybe dive a little deeper into this in a future podcast, but when we have a look at some street level stuff, we want to look at, concentration of owner occupiers versus renters, median household income, any social housing or public housing concentration. So you start mapping out all this stuff. Then we look at transport noise corridors and flood overlay, all sorts of stuff to basically work out what areas we want to focus on and what areas we want to avoid.
Interesting. Yeah, look, they're all just and again, that's the great thing. As I listen to what you're saying, this whole series is about just education, and the whole idea is just to continually educate people. And I know we've said it before, the old scenario of what you don't know, you don't know. So I hope everybody that's listening to this can also go back and look at this and go, right, especially what Jay just mentioned there with the when, the where, and the what is just so important to, again, even chatting to your partner, your wife, your husband, making sure that you're connected on your strategy, which was what we spoke about in episode 1. Yep. So, mate, when you've got, let's say I've got, I've broken up my 1.5. I'm looking to buy 3 properties, maybe different locations to diversify that risk, as we mentioned. So, should I engage a property manager, or should I try and manage those properties myself? Because that's another challenge, isn't it, in our mindset and work and timeframes and expertise.
Yeah. Without question, engage a property manager. So whilst I could personally be more than capable of managing my own properties, because it's what I do, I live in this space, all the rest of it, I see the value of a property manager. Often people think they can do it themselves so they can save the cost and stuff like that. But, obviously check with your accountant, but property management fees are tax deductible expense anyway. But sometimes more importantly, they've got the knowledge, the experience around the laws and regulations in each individual state. So let's take that scenario of you've now got 3 $500,000 properties, one in South Australia, one in Victoria, one in Queensland. Each state has their own rules and regulations around tenancies and landlord responsibilities and notice period times and all sorts of stuff. For you to get a clear, really in-depth understanding of how that works, it's going to take a lot of time and effort and all the rest of it, rather than, again, engaging an expert in that field. Stuff like, they ensure that any rent arrears are dealt with promptly. Maintenance and repairs, they can organise, and we touched on this in an earlier episode, but having a proactive property manager where someone reports a maintenance issue with the property and they can come back to you and say, hey Jay, we've obtained 3 quotes. You can give guidance to your property manager as well and say, look, if we think it's going to be more than $1,000, I want you to get 3 quotes. If it's under $1,000, just happy to go with your recommended trade. So you can give them guidance around that. And then sometimes even better is you can get the property manager to pay for bills, repairs, maintenance, rates, insurance, stuff like that out of the rental account. And the advantage of that is not only you're not having to worry about paying bills and all the rest of it, but if the property manager is doing that out of the rental trust account, at the end of the financial year, they can give you a statement which says rent, basically income and outgoings, and you can hand that straight to your accountant. So it can actually make it a lot less admin work for yourself by engaging a property manager.
Yeah, brilliant. And just brilliant advice. There's stuff there that I wasn't even aware of that, again, I agree. If you can get them to do more, therefore you're doing less, and it's still a part of their fee, the question is, why wouldn't you?
Yep.
So, yeah, brilliant. Love it. Mate, fantastic. Obviously, let's look at wrapping up episode 5. What are we talking about next as we move into, I think I've mentioned this before, so I shouldn't be saying, what are we moving into next? But funnily enough, let's give a bit of a tease to what we're going to talk about next.
Well, this one will be a fun one because we'll be talking about what I do, which is a buyer's agent, and I guess who they are, what they do, why use one, and maybe an insight into what the costs are, and and we can dive a bit deep into what a buyer's agent is.
Brilliant. And I'm really looking forward to this. I think it's a lot of people feel like they can do a lot of this work themselves, but at the end of the day, there's reasons why there's experts in their field. It's a bit like, I was talking, funnily enough, just to go off tangent, last night, one of the guys was talking about doing his own accounts. And I said, how long does that take you? I said, why are you looking to do your own accounts when you've got experts that can do that for you? And you've got to tap into people's brains, and you've got to value your own time. And so, yes, I look forward to talking to you in a little bit more detail in our next episode as we delve into why use a buyer's agent. Jay Anderson, mate, thanks for joining us again for episode 5. Look forward to talking to you very soon. And to all of you out there that's, again, continuing to listen to this series, we hope we're continuing to bring you some new information that can empower you guys to make better decisions. And that's our goal in this new Talking Numbers Property Plus series. So thanks, Jay, and enjoy the rest of your day, and I'll talk to you soon.
Always a pleasure. Thanks, mate.